Okay, so now that we have a more complete picture of the interest rate, where we're controlling both for expected inflation and for the risk premium, we want to put that back into our ISLM model and see, okay, well, where do we need to worry about expected inflation? Where do we need to worry about the risk premium? Where do we need to worry about the nominal interest rate? And so that's what we're going to do in this video. And then in the next video, we're going to use this model to talk about, the housing bubble and what happened when it popped and what happened, in the aftermath and the financial crisis. So we're extending our ISLM model, and we want to think about both the nominal interest rate and the real interest rate, and where the risk premium is and what the central bank is actually targeting. So if we rewrite our ISLM model, what the investment function really cares about is the real interest rate, right? The rate at which they can borrow. And so the rate at which they can borrow is going to depend on, the real interest rate is going to depend on expected inflation and also the risk premium. Now, keep in mind, we're still simplifying things a lot, right? We already said that some companies, face lower interest rates on their bonds than other companies. Mortgage loans are different than auto loans, which are different than credit card loans. So there's still a lot of different interest rates because there's a lot of different risk premium. But we are sort of simplifying it to one risk premium for the macro economy. And I think that's a reasonable assumption in this level of model. So the IS relationship then, C stays the same, so the consumption spending still depends on disposable income. Investment spending now depends on GDP, Y, and then the rate at which companies can actually borrow, so companies and home builders. And so that's going to be I minus expected inflation plus the risk premium. So note that the risk premium shows up in the IS relationship. And then we have government spending. The LM relation is the same, right? I is equal to I bar. They still target a nominal interest rate, although in the next slide what we're going to do is switch everything to real terms so that we have the same interest rate in both equations. It's going to simplify things a little bit, although expected inflation will disappear, but the Federal Reserve is always going to have expected inflation in the back of its mind. And that's going to be important, as we'll see, because expected inflation is actually going to set a floor on how low the real interest rate can go. So here's what we have then. We're replacing the nominal interest rate with the real interest rate so that the LM relation becomes R equals R bar, where R is equal to I minus expected inflation. So expected inflation, while it doesn't show up in either of these terms, is still there. We're sort of taking it as given for right now. It's exogenous. In the IS relation, what we have is the real interest rate, I minus expected inflation, plus the risk premium. Because that's the borrowing rate. That's the real borrowing rate for consumers and firms, even though, as we said, it's simplifying things to one rate when really there's lots of rates. So now we can think about, what happens when, say, the risk premium increases, and we can also think about the importance of expected inflation in sort of the monetary response. So if we think about an increase in the risk premium, that's going to increase the interest rate at which firms and consumers can borrow. That's going to make investment more expensive, right? It's going to be more expensive to build houses. It's going to be more expensive to build factories and buy machines. And so that's going to decrease investment spending and shift our IS curve to the left. Remember, it's a shift because X is exogenous. X is not part of the sort of risk-free interest rate, which is what is along our vertical axis. So in this case, the IS curve shifts to the left, and we get a decrease in output from Y to Y prime. Our equilibrium shifts from A to A prime. So now, we should note that there could be a fiscal policy response to this, right? We could increase government spending and or cut taxes and try to shift our IS curve to the right. But we can also have a monetary policy response, right? And the monetary policy response would be to decrease the policy rate in order to offset that increase in the risk premium. Now, note one thing that when we have the policy rate R here, it can go below zero. So remember, R is equal to the nominal interest rate I minus expected inflation. It's the nominal interest rate that can't go below zero because, you know, a negative nominal interest rate says I will borrow $100, you know, today and pay you back $98 in the future, right? If it was minus 2%. You would never do that because you can always just hold on to that $100 and still have $100 at the end of the year, right? Which is better than $98. But the real interest rate can in fact be negative, but it has a limit, right? So if the real interest rate is the nominal interest rate minus expected inflation, then that means that if the nominal interest rate has a minimum of zero, the real interest rate has a minimum of negative expected inflation. And this is one of the reasons that some economists have argued that we should have actually a higher target for inflation. Instead of 2%, maybe we should have 4%, because the lowest that the real interest rate can go if inflation is 2% is negative 2%. But if it's 4%, then it would be minus 4%. And that would give the Federal Reserve a little bit more wiggle room in situations where they're running up against the zero lower bound. This was obvious. This was not much of an issue before the 1990s, where, you know, the Japanese central bank hit up against the zero lower bound. And then, of course, after the financial crisis in 2008, where the Federal Reserve and the European Central Bank and other central banks around the world hit up against the zero lower bound. But it is an active sort of debate among monetary theorists these days.